Hey, good morning, everybody. Can just for a quick mic check here, can everybody hear me okay? Uh, I think the participation in this webinar will be a little low just because of the fact that, it's a busy time of the year. There's some people just, getting started or working on row crop, and we have some people who are working on, plenty of small grain harvest around the country and up in the Canadian plains. So if somebody can comment and just see if they can hear me, that would be awesome. Is the audio coming in okay? Perfect. Thanks, Josh. Appreciate it. We're going to chat today about the carry in the market, and specifically I've gotten a number of questions about the carry. How do I pick up the carry? And today we're going to take a slightly different spin on it. If you go to episode or lesson 7 in our Business of Farming course, which you all have access to, that really takes a deep dive into how to think about how to use your grain storage as a marketing tool, and really how to think about your grain storage and use it like a grain elevator and not just a speculative tool to, hopefully capture just a higher cash price later down the road. And so really think that everybody should, take a deep dive into lesson 7 in our Business of Farming course, which really takes a deep dive into how to think about your farm, your on-farm storage as a grain elevator. 2 reasons brought us to today's presentation, and one is just have seen a lot of people asking about the carry in today's low margin environment. People are talking about take advantage of the carry, pick up the carry. What does that mean? Well, lesson 7 in the Business of Farming course takes a deep dive into how to think about it from a grain merchandising standpoint. But I think that there's maybe even a bigger point here that we need to be discussing, and that is using the carry as a tool to help you capture more premium prices. And so we're going to hop into the webinar here. You've likely heard in the last year or two, keep an eye on the carry, watch the future spreads, look at that carry in the market, take advantage of it. Well, what does that mean? So many of you are going to know, the next couple slides here. But, first of all, what is the carry? To know what the carry is, the carry is a type of market environment that is based on a spread between two prices. So we're going to look at, this was yesterday, September 2018, hard red winter wheat was trading at 538. July 2019, winter wheat was trading at 595. So the spread is 57 cents, and because it's positive, it's the carry. So this is an example of the market displaying a carry. This is really what the carry in the market is. It's when deferred further out futures prices are trading higher than nearby futures prices. Markets don't have to have a carry for a number of years. Soybeans didn't trade very often in a carry market, and so we'd wrap up harvest, the market would bid for beans, November, December, the basis would tend to appreciate, and you'd look at the board, and here's what you'd see. January, 920, March, 912, May, 910. This type of market is an inverted market. So let's look at a couple more things. You might be saying, hey, Nick, I know this stuff. Jesus is common sense. Give me something actionable. We're getting there. We're getting there. So one of the 3 kind of really important things, bigger picture to focus on is basis tends to follow the carry. we talk a lot about in our courses and our content on how you need to be a cash grain marketing expert. Let's say I like to think of the basis being almost like a speedometer on your car. And you should know, here's where we're currently at, and you have a spectrum of historically poor basis, historically great basis. Where are we at in that pendulum? And by looking at future spreads, that adds another indicator for you to look at on where could that basis potentially be going. So historically, when there is a positive carry, the basis will tend to follow that spread higher. The basis tends to follow the spreads in the market over time. We talk quite a bit more about this in lesson 7 of the Business of Farming course, but you really need to understand that over time, the basis will follow the carry. If there's a carry market, more than likely we'll get some better basis opportunities in the future because a lot of commercials are storing their grain. They have it hedged in the deferred. And so there's some positive tailwinds to the carry or to the basis in a carry environment. And maybe more importantly, we need to be really aware of an inverted market. I'll tell you a quick story. Back in, if it was 2013 or 2014, we had a carry out in soybeans that ran under 100 million bushels. We pretty much almost ran out of soybeans in the US. And in the midsummer, July futures were trading at a premium to November new crop, and then it spiked up. They were trading at $1 plus premium, and then the basis went crazy. So the basis was trading at even more of a premium to November. And at one point, there was a $3 spread higher between summer soybean cash price and November soybeans. And I actually saw an email from somebody that works with grain merchandisers to their list of merchandisers and said, hey, here's a strategy where you can take advantage of this spread. So here's what you can do. You can offer your customers a $1 premium if they don't price their soybeans until we get out into the November timeframe. So essentially what they were doing there is they were offering the farmer $1 of this $3 spread, and essentially just kind of picking the pocket of the farmer for $2 a bushel. And we might say, hey, we have a 700 million bushel carryout in soybeans today. What the heck can I do with this advice today, Nick? Well, spring wheat in 2017, just a year ago, the market went ballistic. We had inverted markets come in. We had the basis, the basis really firm up before farmers realized they had, wow, we do have a little bit better of a crop. Many farms still have some of this 2017 wheat in the bin. And if you would have just used that carry as a guide and said the market is inverted, caution. Whenever you see an inverted market, you should have a red blinking light. Caution, caution. Carrying your grain is a dangerous thing to do when we have a big inverted market. We saw it in, every year or two, we see a market that gets tight on supply. It becomes inverted. That's just a big caution sign that you should be aware of. So this is what I call the landmine, the inverted market landmine. The next time, we've been underproducing demand in corn for a couple years in a row now. Inevitably, we're going to run into a situation where we run tight and our carryout is going to come down. the market is going to get inverted. I think if you can avoid this landmine, it's going to come about in your farming, over a farming career 6, 7, or 8 times. If you can learn to be highly careful of an inverted market, I think that is a way to add hundreds of thousands of dollars of kind of opportunity profit or diverted losses to your farm. So be highly aware of inverted markets when making grain marketing decisions. And so once again, if we have carry, the basis tends to appreciate. In an inverted market, the carry tends to follow the spreads lower. Don't let the inverses pick your pocket. So the next bullet point I wanted to focus on, is taking action. So if you've been on this email list, you have seen that, was it a week ago, 2 weeks ago, I put out an email that said, it's a wheat party. We're having a wheat party. Really all classes of wheat had spiked higher. Prices had went from looking, terrible to, getting back to, our cost of production, break even. And, hopefully for many, some profitable prices presented themselves on both old crop and new crop. And this is one of the reasons I put this webinar out today is wheat is a market that tends to have more carry than most, and frankly has given us a better opportunity here in the short term than a lot of the other crops. So wheat is a market that often shows a carry, and in some of the classes of wheat, it can really be extreme. Carry equals opportunity. Opportunity equals profits when taken advantage of. If you've been following along with the stuff that we put out, I'm a pretty big fan of this grain elevator consultancy called White Commercial Corporation. They really focus on if they can teach their grain elevator merchandisers to be consultative and look out for the farmer, they can build up that long-term loyalty and grow their bushel handle by looking out for the farmer and helping the farmer make better decisions. And so another reason I presented this webinar today on the carry, I was going to present on a completely different topic, but this chart right here is one of the main reasons that I put out this in the first place. So what this chart shows us is that over the last decade, if a farmer were to forward contract some of their crop during August prior to the harvest every year. So if we're looking ahead to the 2019 crop, if we forward contract some of our production today, we are 82 cents to the positive versus selling that grain next June, July. And so 82 cents a bushel. A lot of what we talked about is if we can become a little bit better on price, a little bit better on yield, a little bit better on expenses, that really flows down to your bottom line and can double, triple, quadruple your profitability. And for a farm, for a corn, wheat, soybean farm, that 2 or 3 percentage points better on the price, can be 10, 12 cents on corn, wheat, 20 cents, 25 cents on soybeans. And here we're staring at a chart that shows us if we forward contract our crop this time of the year, historically, over the last 10 years, here's the advantage that we've seen. And you can see this is just a stair step lower of an advantage as we get over time. And the primary reason why is because hard red winter wheat tends to show an extreme amount of carry. Same with Chicago wheat. I'll show that chart next. A little bit less extent on Minneapolis wheat. And in addition to seeing this chart, I've heard a lot of chatter on wheat. Farmers are more interested in growing wheat than they've been in a long time because of, terrible soybean prices. Although, there's some talk that this China tariff situation might get resolved. But all in all, a lot more interest in growing wheat. And I really think, based on conversations I've had, a lot of that excitement is fueled by looking at those prices out in the future. But those prices tend to erode over time. That carry just doesn't stay there. Because hard red winter wheat in July of 2019 is trading at $6 plus futures today, it really has no bearing or no impact on where that price is going to be when you're actually harvesting that crop. So let's take a look at the same advantage in soft wheat, in the Chicago soft wheat. Over the last decade, a farmer who contracts their soft wheat during the August prior to harvest every year. So for example, you'd be selling your 2016 wheat in August of 2015 is 95 cents better than the producer that just sells their wheat at harvest. I mean, holy cow, talk about a crazy advantage by forward contracting some of your winter wheat production. I'm not a big believer or proponent that farmers need to be forward contracting, 80, 90, 100% of their crop, but start to use the carry to your advantage by matching up some of your input purchases with your sales. If you're running crop budgets now and you're looking at this increased wheat price in your budget, more than likely you're using a July wheat price for Kansas City or Chicago wheat, a September price for Minneapolis spring wheat, obviously November for soybeans, December for corn. Just because that carry is there now doesn't mean at all that price is going to stay up there, when we're harvesting. Going back to corn, we've had, each of the last few years, we've had opportunities to sell corn at $4 plus futures. Look at where December 2019 is trading today. The market, the spot market trades at as cheap of enough of a price to buy your grain as it can. And so what we've seen happen over the last 2 years, the vast majority of the time we've spent trading in corn right, between say 350 and 375 corn futures. And I would argue that many of the crop budgets I've seen have showed corn at $4 futures. But when it comes time to actually selling that production, the corn is, we're 25 to 50 cents lower than that price that we've seen in our crop budgets. And that's because the carry doesn't have to stay. And frankly, when a big, huge positive carry develops, it develops in a market that has excess supply. And so the point that I'm trying to get at here is make some early sales. Take advantage of the carry, especially in the winter wheat market, to a little bit lesser of an extent in the spring wheat market. But match up your input purchases with your sales. Don't be afraid to do some forward contracting. And so using the carry, taking advantage of it. If it's there, it has no bearing on whether or not that higher price is going to be there when you harvest the crop. So to take advantage of the carry, you really need to sell it. And once again, we're focusing on, the forward contracting aspects of carry versus the versus merchandising grain that's already in the bin. That's a kind of a slightly more complex topic, talking about managing spreads, potentially locking in spreads. And once again, lesson 7 of our Business of Farming course takes a deep dive into how to use your on-farm storage as a grain elevator. So the other thing we want to look at here is, we're looking at selling some wheat, 9, 10, 11, 12 months before harvest. Obviously want to be looking at the same thing on corn, the same thing on soybeans. Don't be afraid to sell that higher price, because the spot price really is just the market equilibrium of what it's going to take to get commodities moving today. And as we've seen, those higher prices that are shown in the future can really erode away over time in a market that has excess supply. Hint, hint, wheat. The last point is, we did a bunch of research into, we know that the seasonally strong time to market our crop is late spring, early summer. Here's a slide. This comes from some of our Business of Farming content. There's the seasonal tendency of agricultural commodities is to price in risk premium during this time of the year, and then even in a year which we have a below average crop, we can see prices fall off a cliff. August, September. 4 out of 5 years, September is the month of death when it comes to commodity prices. So be aware of that. Even in 2012, 2013, we saw prices fall off a cliff as we entered into harvest. And nothing is a certainty. If these things were a certainty, we could make a lot of money trading this seasonal tendency, in our spec account. But we do want to be highly aware of this seasonal tendency when we're making any of these decisions. So a big stop sign, I think if our goal here is to add, 2, 3, 4, 5, even 10% to our average sold price over the long term and have that money flow to the bottom line, this in itself can get you there. Put yourself in a position to avoid having to sell a bunch of your grain at harvest. We want, the old saying in farming is, you're a price taker. You just have to take the price that's given to you. But if we expand our marketing window, we don't have to be a price taker. We can select, we can have thousands of different prices that we can sell at instead of waiting. So being proactive is a really big piece of what we're trying to focus on here today in the webinar, and using the carry as a reason to take proactive action on managing your bottom line. And hopefully over time, adding, doubling your profitability, I think is very realistic by simply following the seasonal tendencies, selling a carry when it's present. So we do know that markets are seasonal. So let's expand our time window to hit a few of these seasonally strong times of the year. So what do I mean here? If we can be in agreement that this harvest time frame is really the worst time to be selling most of our crop, and according to the USDA, about half of all production of corn, soybeans, and wheat, and I would argue any crop, is sold in this window. So if we say let's break this up into 5 different windows. You have the year prior to harvest, the growing season prior to harvest, and the growing season after harvest. I would sure like to think that for this crop here, we can have, let's look at selling, 15% of our crop in this window, 25 to 35, maybe 45% of our crop in this window, and then the rest here. We don't want to sell any here. If yields are good, at the end of the day, selling a profitable price in this time of the year isn't the end of the world. I personally have a hard time just sitting on grain in the bin, and so I like to get started in this period, amp up sales in this period, and then finish off sales in this period. So expanding the marketing window, especially markets that have carry. I'm getting, kind of beating a dead horse here, and it's like Groundhog Day, but we can, those higher prices that we're seeing specifically in wheat out in those future years, once again, do not have to be there when that harvest comes along. So a market that tends to have carry in it is corn. We've talked a lot about wheat today, but let's look at when the December corn contract hits its high. Most of what we see in this type of statistical analysis is that we look at this period forward, so a 1-year period. But once again, if we're expanding our marketing window, you can see that we've had just as many or more contract highs hit a year and a half ahead of time. I'm not a big fan of selling a lot of commodities a year and a half ahead of time, because if you start mismatching your grain sales with your input purchases, you can run into some pretty nasty scenarios of where you have escalating fertilizer prices, escalating seed prices that can turn a break-even scenario into losing $50 an acre pretty quick. But just look at all those highs that come about a year and a half before we're harvesting the crop. And once again, I'm not saying a person sells 70% of their crop a year and a half ahead of time, but getting a start here can make a heck of a lot of sense. If anybody watches Game of Thrones, they always talk about winter is coming, and winter is this mythical thing that we need to be fearful of, and winter is coming. Be careful, be cautious. This is somewhat surprisingly applicable to farming, and specifically grain marketing decision making. And what do I mean there? This is this is winter. This is the time when 4 out of 5 years, winter is going to be, we're going to be looking and thinking, geez, like, how are we going to make money this year? The last 3 winters have been quite depressing. Geez, it's going to be tough this year. We're looking at a break-even year. And what happened in each of the last 3 marketing seasons? We had a rally in the summer. We had much better pricing opportunities the following summer. That is a very strong tendency. It's not always going to occur, but 75% of the time, we're going to get a better opportunity that next summer. So we need to avoid the, call this, it's obviously winter. The new term that Anheuser-Busch puts out, the pit of misery. We call this the pit of misery. Put yourself in a situation where you're not selling a lot of grain in the pit of misery. I've seen many people who are very good businessmen. You start looking at the carryout. Oh, Jesus, how are soybeans ever gonna rally ever again? I better sell half the crop just to, the market doesn't care about my cost of production. A little loss is better than a big loss. The pit of misery is a very real thing, specifically when we have this seasonal tendency of coming. We have higher prices. They come down in the fall. We think, oh, shoot, I should have sold those higher prices. I better sell something before prices really go in the tank. And then what do you know? Planting's a little late. Planting's wet. We get dry in June. All of a sudden we have this 50-cent rally in corn and a $1 rally in wheat, and $1.50 soybeans, and what do you know? Then the cycle begins again. A lot of what we talk about here is this emotional roller coaster. What we're going to do is kind of pull on that roller coaster and even it out. And hopefully, if this is your break even and the roller coaster is just has some very steep troughs, let's even out that roller coaster and keep the lows at, a break even. And so avoid the pit of misery, avoid the winter doldrums, and using the carry. Right now we're seeing $6 plus hard red winter wheat futures for July of 2019. If you're a hard red winter wheat grower, sell a little bit of that. Heck, we've been looking at sub $5 futures, for decent periods of time the last couple of years. And so take advantage of that carry. Once again, I can't emphasize enough that when those big carries develop, they develop because there's excess supply. So be cautious of that. Take advantage of that and sell. Do some forward contracting during these opportune times of the year. You don't have to get carried away. I know there's a lot of production risk. That's what people from the outside looking in that tend to talk down to farmers. Why didn't you sow grain, you idiot? Well, there's production risk. It's hard. I get it. It's hard. But we want to take a numbers-based objective view and understand that when we're in these periods of the year, we need to be looking for reasons. Instead of having people try to convince you to sell, why should I not sell? If we know there's a 66% advantage to selling that time of the year, we need to be taking advantage of that. And so on the other side of the coin, let's look at when do the lows occur. Like, holy cow. By contracting, this is 30 years, I believe, 30 years of data. By contracting any time out here, the probability that you're going to hit the lowest price is very low. And this chart in itself defines the power of a positive market carry. That carry is such a powerful tailwind to getting a premium price that I really think you almost just have to be selling a little bit of grain now. For in a market that has carry, that is the big reason why we have so few lows here. If you can say that there's an 85% chance that the low will never be in this period, that is very powerful, in my opinion, and something you have to strongly consider. If anybody has any questions on the carry or on any of this stuff we're looking at now, I know it's not rocket science. We're not taking a deep dive into some crazy wild option strategies, but this thought process in itself can get you to that 2, 3, 4, 5, even 10% higher price. That is the difference between the guy that is worth $5 million and has 80% working capital and the producer that has zero working capital. This methodology, these statistics are enough to make that happen in itself. It's super important, and that's why I'm taking so much time to talk about it here today. So once again, the three things that we need to understand: the basis tends to follow the carry. Be really careful of when the market is inverted. That is just the holy grail for grain merchandisers, and it comes right out of your pocket. When the market is inverted, that should just be a flashing red light. We might even have to add a flashing red light to our Harvest Profit software. Market is inverted, be careful. Holding grain is historically dangerous. Don't put your hand in boiling water by keep storing your grain into an inverted market. That is a big thing you always want to keep in mind. Use the carry. You have to take advantage of it, is what number 2 is trying to say. Just because it's there has no bearing on whether it's going to continue to be there. Take action. Use it as a reason to sell some grain. And sorry, I'm a little distracted by these questions here. But use the carry to take action. I'm going to hop over. Josh asked, did I hear you correctly that you don't like putting grain in the bin? It's not already forward contracted. Um, I actually do like having grain there that isn't forward contracted, but if we can all agree that the best prices of the year come late spring, early summer, having all or the vast majority of our grain completely open, it's just hard for me, hard for what I think a lot of people to sit on that grain for 9 months and wait till that seasonally opportune time. In my part of the world, we had terrible prices for corn last fall. 275, 280, 285 cash price. Ugh, gross. And what do you know? As soon as that market popped up and got to $2.95, $3, there were semis of corn hauling everywhere. And so what I see happening to a lot of people is you have a bunch of grain in the bin. Let's say, hypothetically, we see some random commodity. I'm just going to name a random price here to take it away from commodities, but to take it away from focusing on a certain crop. Let's say we have a commodity that's $150. You put it in the bin at 100. As soon as it gets to 110, it's really hard to not sell a big chunk of it. And if I've seen it happen once, I've seen it happen 100 times. The market will leak lower, and then the first pop higher, we just sell a bunch of it because we don't want to be wrong again. So, Josh, I don't think all the crop needs to be forward contracted, but for me personally, I find it hard to sit on unpriced grain from harvest all the way out to that seasonally opportune window again. And then using the carry, we go back to this chart of corn. I'm a pretty firm believer that the carry itself is the driver behind this. So in markets that tend to display a lot of carry, and that can be corn, the classes of wheat primarily, and maybe we'll see it on soybeans this year with what is projected to be an extreme carryout. The carry is what causes this. We need to be aware of this. That let's think of the farm like a casino. If we have a 70% probability that this, a 90% chance that this will never be the low, let's sell some grain there, specifically if you're going to be buying fertilizer that time of the year. So use the carry to expand your marketing window. Understand that it's a big driver in why premium prices are available. Premium prices for future delivery slots are available to us today. And then I've alluded to it here a couple times, but I really think that this is a secret bullet to pad your bottom line. Christian Hebert talks about the 5% rule being 5% better on price, 5% better on inputs, 5% better on yield, can really have huge impacts on your bottom line. I think it's, you can take it down to 2% of each one of those can double your bottom line pretty quick. This, I think over time, will add 2% to your bottom line if you be aware of the carry and just understand that because hard red winter wheat prices are at $6 plus futures for new crop, certainly doesn't mean they have to be there going forward. And in addition to it, when everybody's excited about planting a crop, you can be excited about planting the crop, but you should be looking at selling the crop as well. So all in all, heard a lot about carry. I've heard a lot about look at all the carry in the wheat market, but as we've seen by those great slides showing, brought to us by the guys at White Commercial Corp, that carry over time just eats away at those premium prices. So don't be afraid to forward contract some crops during periods of extreme amount of carry, because that can really be the tailwind towards getting you a premium price. And Vanessa will probably, I like that flashing light idea. I'm going to talk to my guys about that, implementing that in a lot of different ways in our primary harvest profit software. So I thought this was very relevant given the growing interest in wheat for 2019, given where soybean prices are. And I've seen a number of people who don't really understand the carry. So from a forward contracting, from a budgeting standpoint, this is a really important concept. And then from just a grain merchandising standpoint, check out lesson 7 in our business of farming course, which all of you have access to, for a real deep dive into how to approach your, how to use your grain storage as an elevator. So all in all, that's it for today. A simple but powerful message. I will be wrapping this up into a standalone video that you can watch at any time to review these charts. Thank you everybody for joining me. If you have any questions, shoot me an email, nick@harvestprofit.com. We're pretty pumped up about this Ag MBA program. Would love if you could, share what we're doing. Share the link, harvestprofit.com/Ag MBA. We're going to try to bring on some powerful speakers onto these webinars, some people that come from outside the farm. Tend to be some quite expensive resources to put in front of you, but we're pretty excited about bringing this new kind of grown Ag MBA offering. So if you know anybody who you think would be interested, we'd love for you to share. harvestprofit.com/Ag MBA. We look forward to really growing this platform going forward. So thanks for taking the time out of your busy morning to spend with us. Once again, if you have any questions, nick@harvestprofit.com. Thank you.